Forget the noise. Brent Crude is sitting at 110.42, and right now, almost every retail trader is looking at this chart and thinking the same thing. It's going to 114. And that is precisely why you are about to lose money if you don't understand the trap that's being set. I'm going to show you a danger zone hiding above 111.91, and a hidden sniper entry that could pay you 3 to 1 if you have the patience to wait for the sweep. There is one invalidation level that destroys the entire bull case, and if you blink, you'll miss it. Stay until the end. I'm giving out exact numbers for the conservative sniper setup and the aggressive breakout chase. Let's cut through the fog right now. The session bias is trending, but we are entering a high resistance cluster that makes immediate long entries extremely dangerous. We are fading the initial poke into resistance, waiting for the market to either prove itself by absorbing 111.91 or punishing the late longs with a swift rejection back to 107.09. My structural grade for this session is a cautious trend continuation only on a confirmed 4-hour candle close above 112.00. Here is your interactive trigger. Write this number down. If we break and hold below 107.09 on the 4-hour close today, the whole structure shifts from a buy-the-dip regime to a range-bound, potentially bearish, correction. That is the line in the sand. Let's zoom out to the weekly and daily charts, because this is where the institutional conviction lives. On the monthly time frame, we are witnessing a recovery from a deep macro correction. The MACD is curling up from a low base, suggesting we are in the early to mid stage of a momentum cycle. This isn't a dead cat bounce. This is structural repair drop down to the weekly. This is a brute force buy signal. We have strong bullish momentum with moving averages fanning out positively. This is what we call a bear killer formation. The 20-week MA is accelerating away from the 60-week MA. When you see a fan like this, any dip towards the rising moving averages is a buying opportunity for trend followers. The path of least resistance on a macro scale is higher. Now, let's bridge this to the daily chart, because this is where the tension lies. The daily chart just bounced off the MA40 support level, which lines up almost perfectly with your major support at 103.50. Currently, the price is riding above the daily MA20 and MA60. The MACD just printed a bullish crossover. Visually, this is a textbook long signal. But look closer. The distance between the current price at 110.42 and the 200-day moving average is creating a vacuum. We are in a zone where the macro trend is positive, but the short-term positioning is becoming overextended. The algorithm targets here are clear. The magnet is 111.91, the major liquidity pool above 114.07. This is where we separate the amateurs from the professionals. Let's drill down to the 4-hour and 60-minute charts. The 4-hour chart is riding the MA5 and MA10 upwards, which is true. Price is hugging these short-term averages like a rail. But here's the red flag, the trapdoor I mentioned. The 4-hour MACD is showing a slight intraday exhaustion near the 109.72 resistance, which we have just nudged past to 110.42. What does this mean in plain English? It means the buyers are getting tired. The histogram bars on the 4-hour MACD are compressing. Momentum is not accelerating into this resistance. It's limping into it. When price grinds higher into a resistance zone like 111.91 with flattening momentum on the lower timeframes, it creates a bearish divergent setup that invites algorithmic short selling at the resistance level. The immediate support is the zone between 107.09 and 106.50. That is your near-term value area. Below that, the 104.93 level aligns with the daily MA40, making it the ultimate make or break floor for this swing move. If we test 104.93, you're buying it with both hands, assuming the structure holds. But right now, chasing a breakout at 111.91 without a confirmed catalyst is simply paying the markup for impatient money. You want to buy the reaction, not the breakout candle. Now, let's connect the price action to the news flow because the technicals are warning of exhaustion, but fundamentals can override everything. Brent is the geopolitical heartbeat. We need to cross-check the inflation versus geopolitics premium. In the last 24 hours, Supply tightness narratives have dominated. We are seeing continuous draws in physical crude inventories, which provides the fundamental backbone for this weekly bullish trend. However, here is the cross-asset friction you must watch. We are looking at a strong US dollar index. Typically, a strong dollar caps commodity rallies. Right now, Brent is rallying in spite of the dollar, which tells you the supply fear is genuine. But if the S&P 500 starts to roll over, remember, S&P is the liquidity tide. Risk-off flows could force a liquidation break in oil, breaking that 107.09 support violently. Watch the correlation with gold as well. Gold is the fear architect. If gold spikes on geopolitical headlines but oil starts to diverge and drop, that's a false supply scare. It means oil's risk premium is deflating. For the 1 to 2 week market outlook, the path of least resistance is higher as long as we hold 104.93. The event that invalidates this entire bullish thesis is a confirmed breakdown below 103.50 on the daily timeframe. If that happens, the monthly MACD curl fails, and we are looking at a failed breakout that could cascade down to the low 90s range. Most people will skip this, but this is where steady profits are made. Keep watching. This is the sniper setup for those who refuse to chase market price. You are waiting for the market to come to your preferred entry level. The exact trigger condition for this entry is a pullback into the 107.50 support zone. The entry zone is 107.50. You are not buying the current price at 110.42. You are setting a limit order or waiting for price wicks down to this zone. This level represents a stop run on week-long traders who entered near the recent top. Your stop loss is placed at 106.40. The technical justification is simple. If price breaks below the immediate support cluster of 107.09 and the swing low around 106.50, the intraday trend structure turns bearish. You need to exit early before mass sell stop orders get triggered. Leave reasonable price buffer space below key structure levels to secure your position safety. Take profit 1 is 109.70, sitting just below key intraday resistance. Take profit 2 is 111.80, right hitting the core major resistance cluster. Your total risk on this trade setup is controlled tightly. The first target delivers a 2-to-1 risk-reward ratio, while the second target extends the ratio up to 4-to-1. This is a high-probability mean reversion entry strategy built on repeated algorithmic price behavior around core support zones. Now we move to aggressive trading style. This is high-risk and high-reward breakout momentum trading. If you hate waiting for price pullbacks and prefer riding strong market momentum, this setup is for you. Yet you must follow strict filtering rules to avoid falling into classic bull traps. Never enter long on the first price touch of 111.91. Your exact entry trigger is a solid 4-hour candle close above 112.00. Not temporary price wicks, not instant price spikes, only full candle body closure above the psychological 112.00 mark and the technical resistance level at 111.91. This close fully confirms market absorption of selling pressure, proving all sell wall orders have been fully consumed. You can enter right after the confirmed candle close, or join the trade on a minor retest of 112.00 turning into new support. With ideal entry price around 112.10, set your stop loss tightly at 110.40. This breakout setup is fully invalidated once breakout candles close back under 111.91, which traps all late breakout buyers instantly. The core logic behind this stop placement is that failed high flag breakouts always trigger sharp violent price reversals. Take profit 1 is 113.50, marking the next key volume gap resistance level. Take profit 2 is 114.00, the strongest major structural barrier on the upside trend. The risk-reward ratio here is relatively compact. You take defined risk to capture immediate momentum gains. Confirmed high flag breakouts carry solid statistical winning rates, making this trade worthy of execution as long as you apply timely trailing stop tactics. One critical warning: this is pure momentum chasing. If red reversal candles appear right after you open positions, do not hold blindly. Exit and reanalyze the market trend immediately. Let's check our market viewpoints together. Leave your predicted Brent crude price range for tomorrow in the comment section right now. Do you believe price will face firm rejection at 111.91, or will price break cleanly higher toward 113.50? I check all comments every single day, and I will pin down the most accurate and logical market analysis. Most retail traders are holding bullish views right now. This market sentiment is extremely obvious. Yet real trading edge comes from recognizing when widespread bullish sentiment turns into overcrowded trades that face large-scale forced liquidation. Now we move to the most essential non-negotiable trading rules. Never risk more than 1 to 2% of your total trading portfolio on any single trade, no matter how perfect the technical setup appears. Fully avoid holding open positions through high-impact financial news releases, including unexpected crude inventory data updates and official OPEC policy headlines. Fixed stop-loss orders are mandatory in every single trade. Getting stopped out is affordable trading tuition for valuable market lessons, while blowing out your entire trading account ends your trading journey directly. Always stick strictly to your pre-planned trading strategy instead of chasing instant floating profits blindly. To wrap up all core analysis. The most decisive price level for the upcoming trading session is 107.09. A heavy volume breakdown below this level will force this entire bullish oil cycle into sharp sudden stalls. As long as price holds firm above this key support zone, the upward march toward 114.07 will continue steadily in mechanical trend movement. Tomorrow we will focus deeply on US dollar index trend shifts and analyze how S&P 500 gamma squeeze movements drive the overall trend of global risk assets. If you want complete detailed analysis covering Bitcoin market trends and S&P market divergence logic, the dedicated full analysis video is already online. You can find it on the end screen. The trading signals shown in those markets are even more extreme compared to current crude oil market conditions. Hit the like button if this professional institutional level analysis has sorted out your clear trading execution plan. User likes help platform algorithms filter out valuable market signals from useless market noise. Subscribe to this channel and turn on notification bells to get daily exclusive institutional market trend coverage. I deliver you the complete market trend map, and the final execution relies entirely on your own discipline. Stop blind price chasing. Use precise sniper-style entries to capture steady profits. I will meet you all in the next professional market analysis video.